Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Take two. We are episode 133 of the Carson's Facts versus Feelings. Sonu, you do the title. I'm going to screw it up again. What's our title? We're struggling today.
Did the stock market just win the tariff throwdown?
There it is.
I think I got that right.
I guess that's good. I mean, we had a throwdown. Now, I will say this real quickly for the YouTube channel. I'm not wearing my normal headphones because, as you can see here, like the little squishy part came off, okay?
The cup.
And, you talk about productivity. I've been incredibly unproductive for about 15 minutes. I've been trying to put this little squishy part back on my headphones. I mean, Sonu, I can't do it. I just can't do it. Have you ever had struggle with something like that? Because it's I'm just ready to buy some new headphones. I can't figure it out.
I'm supposed to be a mechanical engineer, and I struggle with anything that involves, like doing stuff, making stuff, repairing stuff with my hands. Yeah. But no, every time I put these headphones, I'm wearing it right now, into my bag. I take it out of the bag, the cups are gone. And then I'm struggling to put it back. And, our producer, Josh, mentioned, look at YouTube. And speaking of that, so my sister's visiting from India for a few months with her 15-month-old. And I have procrastinated a bit in terms of getting gates. We have a lot of stairs. Ryan, you've come home. You've seen the stairs. You don't want a 15-month.
I fell asleep on your chair for a couple of minutes after a long day at a football game. Yeah.
So, I had to get the gates, and I've been procrastinating because, I knew like, oh my God, I'm going to have to put these gates on. And, I looked at YouTube. Goodness, it did not work well. Finally, I just called someone and asked them to install it. So there you go.
It's a good thing you're not an engineer. Apparently. Anyway, all right, well, let's get into it because we actually, for the first time in a while, have some good news. By the way, thanks to Kathy Wood, who joined us last week, founder over at ARC Investments. I forget her exact title, but we'll just say ARC. Hopefully,
CEO, CIO, founder.
It was a great discussion, but this is kind of the first one we've done in a couple weeks with just you and I, Sonu, where we're really going to dive into markets. I mean, let's just start with it. There was a rumble, right? April 2nd. Was Liberation Day.
You still have that wrestling theme going.
Yeah, I'm trying to keep the wrestling theme going. It's just funny because, I don't look at Facebook that often. When I do, I always get these 1980s wrestler interviews popping up. You can tell what I like to watch on the algorithms. I love to watch, Jimmy Snuka versus Roddy Piper. But in the interview, when they're just going at it, call me a child of the 80s, I guess.
I was more early 90s when I was into that stuff. Bret the Hitman Hart and, all of that stuff, right?
I was like Rob Van Dam. I was like the
Macho
ECW.
Man Randy Savage.
ECW is a little more hardcore. I guess I was a little older then. I enjoyed that one. But enough of that. We've had some rumbles out there. Is the rumble over, right? Did Washington cave? Did President Trump cave? I don't know. I did see something that Navarro hasn't tweeted, at least at the time we're recording this. We're recording this on, 29th? We're recording this on the 29th, so Tuesday 29th. He hasn't tweeted since April 18th. And I'm going to guess that was he was told not to. And honestly, since April 18th, we've done pretty good. Is it as simple as put Navarro away? Don't let him talk.
And maybe Lutnick too. I mean, between Lutnick and Navarro.
Yeah. I listen to a podcast with Lutnick. I like the guy, interesting guy, but I'm with you. When he opens his mouth, market doesn't like it.
No, I think it was Neil who put together a note. Neil put this great chart up showing anytime Lutnick and Navarro are in the news, markets go down. Anytime Scott Bessent's in the news, markets go up. And you've had a lot more Bessent than Lutnick and Navarro. I say this, I think just this morning I saw Lutnick's got an interview today, so brace for impact.
Yeah, I think it's in the afternoon. I'm actually on TV in the afternoon, so I better pay attention to what he says. That's true.
Or not.
Yeah, that's true too. So let's get into it. The markets rallied a lot last week. So today we're recording this. We saw some potential better news with autos. I haven't had a ton of time to dive into it. I think my take is the market, after the rally we've seen, has sniffed out Washington's. I'm not calling the white flag is up, but they're definitely pulling back. And that's why I think the market's rallied so much. But I mean, where do we go from here with trade, Sonu? Let's put it all together.
I think last month, just backing up even last month, right? Remember Scott Bessent was like, no, this is the victory for, even a month ago, before Liberation Day. Markets are down. The peak was what, February 19th?
There was life before Liberation Day. I don't even remember it. It's like, remember before COVID, after COVID? It's kind of like before Liberation Day, after Liberation Day, for those of us in the podcast world.
BLD, ALD, you know, like, there you go. BLAL. But anyway, no, markets are going down even before that. But at that time, the tune coming out of the White House, even Scott Bessent for that matter, is like, oh no, this is for Main Street. And, you know, Wall Street's getting hurt, and it's just a Mag 7. They were up a lot. Now they're down. And markets go down near 20%. Suddenly everyone gets worried. Bond markets freak out. Everyone gets worried. We talked about that, right? And they're like, oh, maybe we can take that pain. So that's why, like, we had a little bit of a throwdown, right? Like, the Trump administration tried to be like, oh, here are the big tariffs. You know, stocks, do your worst. And they started to do their worst. And then they blinked.
Yeah,
they said, oh, you know, now we're talking to China. But even last week, right, the S&P 500 is up, what, 4.5%, 4.6%.
Yeah.
But it was hanging on every single thing that came out of the administration, right? Equity markets, you and I know, it can be volatile. We talk to clients, we talk to advisors about that.
Oh, yeah.
But all of this is being driven by policy clarifications, walkbacks. Sometimes the walkbacks are walked back. President Trump said he's not going to play hardball with China last Tuesday evening, and suddenly the S&P 500 next morning was up 3.5%.
Oh, yeah.
Then that afternoon they said, oh, you're not going to reduce China tariffs unilaterally. They need to pick up the phone and call us. The index fell 2%. Then again, we rallied on Thursday. We rallied on Friday as well. But we saw like 11 intraday 1% moves. 11 of them in 5 days. It's crazy. But, you know, and then we had, I think it was Thursday or Friday, Trump was like, yeah, I've talked to Xi. Now, he didn't say when. It could have been 2 years ago. It could have been 3 years ago. It could have been 4 years ago. But Chinese embassy said there weren't any calls. So, like, we're doing this all. He said, Trump said, Xi said, you know. Yeah. And Bessent was on weekend TV. I think you and I talked about this on the advisor call yesterday morning. And he's like, I don't know if they've talked. Well, I don't know if that's a good sign. But anyway, there was a showdown. I think markets have won this round. I don't think it's over yet. They've won this round. They said, you know, be careful. If you want to remake the global trading system, that means you're remaking how companies make profits around the globe. And they make a lot of profits, and a lot of these profits accrue to U.S. companies. Be careful messing around with it. And I think the administration pulled back a bit.
Yeah, we wanted to maybe call this he said, she said, she, of course, XI, because the confusion over who's doing what. I guess I'll put it this way, since we talked about last week, what wasn't confusing was some of the strength we saw. Sonu, the S&P 500, and Josh, we can put this chart up on YouTube right now. The S&P gained at least 1.5% 3 days in a row. That's really, really rare. The previous 10 times it's happened since World War II, only 10. The S&P 500 was higher a year later, 10 out of 10 times. I mean, you know, it's kind of one of those, it is what it is. You're talking up over 20% on average. Really, really strong. And in the 3 month, 6 month, 9 months later across the board, you tend to see outperformance. So it's like a blast of strength, a buying thrust, if you will. People say all the time when you have these big one-day rallies, it's a bear market rally, it's short covering rally. I'll give you that. That's fine. But when you have multiple days in a row of extreme strength, like we just saw last week, and let's also not forget on Monday we came in, President Trump wanted to fire the chairman of the Fed. And then on Tuesday,
we forgot about that.
Yeah, exactly. Yeah, isn't that crazy? Like what a world we live in. Like that's 50 years ago, that'd been really big, or 20 years ago, that'd been really big news. Now we forget a week later. Anyway, he walked that back too. So that kind of Tuesday was a bloodbath. I'm sorry, last Monday was a bloodbath, down 2.4%. Then the next 4 days we rallied on Monday. The time we're recording this on Tuesday could be the 6th up day in a row. We'll see. I took a look, Sonu. Let's assume we are up 6 days in a row. And who knows? By the time to listen to this, maybe I'm dead wrong. The last 20 years, it's happened 16 times. Those 4 years that did not have a 6-day win streak, you're talking like 2011, 2008. Some of the real 2015s in there. Some of the real negative years that we've seen, like down years. All 4 of them were down on the year. The 16 years, again, we went back 2 decades, that had at least a 6-day win streak, at least one of them. Okay. 15 times the market was higher on the year. The only year that was down with the 6-day win streak was 2018, which honestly, does that sound familiar? 2018, when the trade war started, early
Don't remind me.
But there was a big rally. People forget this because the trade war started, had a really quick 10% pullback, correction, I guess the word I should use, in February of 18 when the trade war started. Then we rallied back to new highs by September. Then August, October, November, and then the Fed kind of didn't really give the market what it wanted. It had a bear market in like 3 or 4 days back in December, which really made that look like a bad year, and it was. But there was some opportunity in 2018. So anyway, just some things to think about. Now, one more, then I'll bring you in. If you follow me on social media or turn on TV in the last couple of days, you've heard about this. The Zweig breadth thrust. Keep this real simple. And Josh, we can put this up on the YouTube channel. The 2 charts I shared is the second one. It's when you have a bunch of stocks that are oversold, move to overbought in a very short time frame. We'll keep it real simple. That's kind of what the Zweig breadth thrust is. But as you can see on YouTube, and I'm going to say now, 19 times we've seen one of these, going back to World War II, 19 times the S&P 500 was higher a year later. 6-month returns really strong, 3-month returns really strong. It's kind of like a washout, and then the buyers step in. And yes, I get it. We get it. Every time is different. There's lots of worries right now. Maybe P multiples are still a little pricey. All these things are still out there. But I'm telling you, you look at those other 19 times, you probably were selling off before the rally. People were worried about something then also. So it's just one of those things to pay attention to, that with the Zweig breadth thrust, with 3 days in a row of a 1.5% gain, with the fact the S&P 500 found support at its 2022 peak, also a 50% retracement from the October 2003 lows to the February earlier this year's highs, pull that back. That's right around 4,900. I mean, there are some logical areas of support with the over-the-top negative sentiment. Maybe we can dive more into sentiment in a second. All this to me suggests, you know what, I'm going to go on a limb. I think the lows of the year are in. Believe me, I could be wrong. It doesn't mean we're going to go straight up. It's going to be choppy. It's going to be frustrating. Maybe you go back down at some point this summer. But I tell you, this is consistent with how lows have formed before. Now, we'll see. I mean, trust me, I get it. We'll see. But I think the lows were in. Sonu, what do you want to add to that, or where are you going to take this conversation?
You mentioned something about, when you mentioned 2018, you said the Fed disappointed people, right? Yeah. And there is an aspect of reflexivity. Things don't just happen in a vacuum. Policymakers react to that, right? Usually, and I think you've had this great chart. I don't know if you have it. Maybe, you can send it to Josh to put it up. But this great chart showing how we've had so many near bear markets over the last 10, 15 years.
Yeah, we'll put that. I'll get that to you, Josh. We can put that on the screen right now.
I love that one. Yeah, because it shows suddenly we get to 19%, 19.9%, and boom. Nobody wants a bear market. Policymaker, the moment you hit a bear market, suddenly because if you're down 20%, 30% is down 30 is not very far away, especially given when you're down 20%, volatility is high. So you could, easily think, oh, we could be down 30 in a hurry. And then things really start to get worrying, especially because, there's a wealth effect, things like that. Maybe people are spending more if they feel more wealthy, if they feel like they have more money, they're making more money in the stock market, things like that, right? It's a little loose, the connection, but still, it's there. And I think that's what's happened is, over the last decade and a half, anytime we start going down to that range, suddenly the Fed steps in. Yep. Somebody steps in before things get really bad. And this time we didn't see the Fed. We can talk about the Fed. We have a Fed meeting next week, or we could save that conversation for next week too. But we did see policymakers step in, except in this case, it was a White House coming in saying, oh, you know what? We are thinking twice about doing these extreme tariffs. So we did get a policy change. That's really what drove, yes, there was a lot of volatility, but I think markets are pricing in the fact that they're going to pull all this back. I think it's straightforward, as simple as that. I think there's more to come because the tariffs are still on. We can talk about the tariff impact, but for now, the tariffs are still on. I think everyone's trying to figure out what is that going to do to the economy? What is that going to do to profits? I don't think anybody has an idea yet.
Well said. So I do have that the data, and we'll maybe put it up on the YouTube channel again one more time. In October 1990, had a 19.9% near bear market. In the fall of 98, a 19.3% near bear market. 2011, if those remember that, after the U.S. debt downgrade and then some real volatility, 19.4%. Then in 2018, the one I just mentioned, hit 19.8%. Now, these are all closing basis. Let me be very clear. Many of these actually hit 20% intraday. Does that sound familiar? Because we just hit 20% intraday earlier this month, but on a closing basis, 18.9 is what we where we are right now, or where we just had with this near bear market. And then there was actually one in 1976, also a near bear of 76 was the peak, bottomed in March of 78, 19.4. So I mean, yeah, hey. Lots of numbers there, but I guess the truth is we've had some near bear markets before,
and maybe intraday it goes down,
and intraday you hit them, and trust me,
and then suddenly like there are calls to the White House, there are calls to the Fed, they're like, guys, you guys got to step in here.
Yeah, and if you do this like we do for a living and work with people, it felt like a bear market. I don't care what anybody's going to tell you. I mean, trust me, this was wild. I mean, this felt like a bear market. Mag 7 down 30, 40%. I mean, a lot of areas down a lot more than 20%. If you manage money, you work with clients, the emotions that come with all this stuff. Oh my, it was not fun, and it felt like a bear market. But again, maybe we just avoided another one. So, Sonu, let's see. What else you want to talk about here? We've got time. Where do we want to take this conveation?
Do you want to talk about tariff impact? I mean, I know Thorsten.
No, not at all. No, not one bit.
I know. Or
no,
maybe,
we can. Yeah,
maybe someday we can have Thorsten Slock on the podcast. I don't know if he'll come, but you can try.
I don't know if he does. Yeah, we're big fans of Thorsten. I don't know if he does interviews.
Yeah.
I don't know. I've seen him on Yahoo. He's been on Yahoo before.
Okay. Whether he's got, it's not like we agree with him all the time. I mean, in 2023, I think he was worried about recession. Yeah. He obviously won. We can actually talk about that. But, he had this interesting chart deck going around. It was on Twitter, and, I pulled that down. I looked at it. I was like, I don't quite agree. And which is not to say I think I'm right or anything like that. I have some issues. But he was talking about the fact Josh can pull this chart up showing how, we got the Liberation Day tariffs. And a few days after that, a week after that, freight from China, container ships sailing from China to the U.S. trade stopped.
Yeah.
Really stopped, right? And what's interesting is that it doesn't actually capture the full picture of what's happening because there are lags, right? What Thorsten is getting to is the fact that, shipping stopped, right? But that also means, let's say April 10th, trade between U.S. and China shut down, right? There are less containers coming to the U.S. And Molson Hart at a consumer products company on Twitter had this nice thread saying that, once the containers, once the stuff is sent from China, it takes about 30 days to get to LA, 45 days to get to Houston, 45 days to get to Chicago by train, 55 days to get to New York by sea. And that means we technically won't see the impact of trade shutting down between the US and China, at least until the second week of May. And after that, what happens? Trucking work dries up. Because port activity dries up because you don't need people to unload containers. And then if trucking activity dries up, you don't need people to unload containers at the warehouses, which is where, the trucks take all these different goods, right? So that some products could be out of stock. We're potentially looking at job losses at ports, warehousing, trucking, all of that. Some of our advisors, it's a good question, like, where will you see the impact? I think, look, if we start seeing job losses at all these places, if that spreads, remember, recession is not, we get a trucking recession, and that means it's an overall recession. You need to see a recession in terms of a broad-based decline in economic activity across the board, right?
Right.
It shouldn't be just the goods sector, but it could start there. And what Thorsten is getting at is like by mid-May to late May, trucking demand comes to a halt. Then you get some empty shelves, and companies are responding to lower sales. By early June, you get layoffs in trucking and retail. And by summer 2025, let's say June, July, you have a recession, right?
Okay.
I am not completely convinced of that. I'm not saying I'm going to be right. I'm not saying Thorsten's wrong, right? He could be right. Who knows, right? But I'm not completely convinced that we'll get a recession by June, July. Mostly because tomorrow I think GDP data is coming out. We'll see that there were a lot of imports in February and March because people are front running the tariffs. So I think people have inventories for now to last maybe the next 2-3 months. I think where the problem will come is if these tariffs stay in place through May, through June, July, then this is the time people order stuff for Halloween to Christmas.
Right.
Then we have a problem for those months, right? And I think, like I wrote a piece about what's the bull case, what's the bear case. I think, I don't think the bear case is very likely because we'll see, policymakers, we'll see the White House pull back, or they'll say, oh, we're getting deals, whatever, whether they're, in name only or whether there's something real, who knows, right? I do think at some point we'll start talking to China because we have to. We can't just say, we're not picking up the phones, both from China's perspective and the U.S. perspective. You can't just be on like a cold silence. It's like this married couple that won't talk to each other. At some point, you have to talk, right? Even if it's to get a divorce settlement, you have to talk, sure. Right? Mm-hmm. That has to happen. But, the longer this goes on, the worse it is, right? And then the question is, okay, what happens to profits? But let me pause there. What do you think about?
Well, no, some great points there. I mean, I saw an article out there talked about, like you said, Halloween costumes, and they're saying, listen, we got to solve this soon, or we're gonna have some issues with our Halloween costumes coming up here. 5 or 6 months. Average Halloween costumes about $19.99, so they could go up about $27-$28. Now, listen, this is just one thing that I read, but those are some of the worries, the real world worries. I mean, nobody wants to go back to, 22, early 23, when if you had an issue with your washing machine and you needed some part, well, we can't get it because it's coming from China and everything's stuck on ships in LA. That is something that nobody wants to go back to. Whatever the reason on the supply chain is, but just if you want to buy something, we like our stuff and we like to push a button and have it show up the next day or two. And you'd have to think Washington knows that. And the other thing, Sonu, I don't know if I want to point it out, but I guess I will. Let's get the toothpaste out of the container. Midterm elections aren't that far away. Okay. So if you really start to cause some problems and upset people, and you and I have talked a lot about consumer confidence, I believe the Michigan consumer confidence goes back to like 1950s, like the 4th lowest ever. All right. I mean, consumer confidence, worries about inflation, all this stuff is real. Yes, a lot of it is political, but if you look at those independents, and you pointed this out, independents are starting to get a little more dour on the economy and expecting higher inflation. That's the stuff that kind of moves needles and, honest to goodness, moves elections. Now, then again, the midterm elections are ways away, but maybe you blink and it's not that far away. I don't know. There's some of that in there, but I'll tell you, as a old school John Murphy disciple, technicals and markets, the message of the market, I don't know. To me, the message of the market is we might start work our way higher here, and the lows might be in, but there's still a lot of uncertainty on the macro backdrop. I'm not naive to that. I mean, we manage a lot of money, and trust me, it's not like we're just wildly overweight equities. We see the same risks and concerns that a lot of other people see. What's one thing that does worry you? I mean, like a legit, maybe we've already talked about it. Maybe it's trade. I mean, this just keeps going. But what worries you a little bit?
What worries me is a slow burn, a slow decline in the economy, and maybe markets too, for that matter, right? Like we never get to negative 20% again. Let's say the lows are in, but we are hovering between, a 5% rally could take us to new all-time highs, but we don't quite get there. We are hovering somewhere between 0% off the, all-time highs, let's say 1% off of it, all the way to negative 10, negative 12, something like that, right? And that's because it's one thing, like let's say we had a crash right now. I certainly don't think that's going to happen, but let's say, I could be wrong, but let's say we have a crash right now. June, July, the economy comes to a stop. But, I don't see that because, I can still go to my barber, right? It's not like COVID, right? But if we did have that, I think then Congress is in the middle of writing a tax bill, right? They could easily say, you know what, if we come to a sudden stop, we are getting more support out to consumers. You can bet that President Trump will be the first one saying, send checks out again.
Oh, yeah.
Forget what happens to inflation. He's the guy who came up with the idea of checks in the first place. Right? He wanted to send checks again, and then Biden got sort of suckered into it. And then he was like, oh, I'll send checks too. And then, we got all inflation and things like that. We won't get into all of that. I mean, that's all over. But still, we could see support. But then if we don't get the crash, which is what I think, I don't think we get into a sudden stop for the economy in June, July, anything like that. But if you get a slow burn, right? Congress writes a tax bill. Let's say by July 4th or early August, we get a tax bill. our taxes won't go up. Okay, that's good. But we are not getting a lot more support in terms of tax cuts, things like that, right? Maybe a little bit on the edges. And then the unemployment slowly goes up, 4.2, 4.3, 4.5. Let's say it goes to 4.7%. Meanwhile, inflation expectations are on the higher side. You already talked about consumer expectations of inflation, but let's set that aside. Let's say consumers are, always too worried. It's a contrarian indicator. But business expectations of inflation also going up. I mean, Josh, you can put up this chart about business expectations of inflation. This is from the Atlanta Fed. It's up to 2.8% now, right? Mm-hmm. The Fed's looking at this and saying, the unemployment rate in our March dot plot, we said we could cut 2 more times in 2025. We think the unemployment rate will be around 4.4, 4.5%, somewhere around there. So they're okay with that level. Let's say we don't get there for a few months, in which case I don't think we get rate cuts. And we know that rates are still meaningfully restrictive, which hurts, cyclical areas like housing, manufacturing. And then we're getting the slow burn, nothing. We're not getting that oomph from the economy, from these cyclical areas, because what do you need for economic growth? Yes, consumption will may keep us at 1.5%, 2%, or even somewhere between 1% to 2%. But for real growth to, go above 2%, you need housing to work for you. You need manufacturing to work for you. You need investment to come through. You're not getting any of that if rates stay high. So for me, it comes back to the Fed. How is all this stuff going to impact, what the Fed does? And the longer the Fed stays, let's say higher for longer, I think the worse it is for the economy. Because I think the tariff situation, look, if it gets worse, the markets will, literally vomit again. And then the White House will pull back, right? They have to. So I honestly don't think they can keep tariffs at extreme levels. Now, it will make a difference whether China tariffs come to 60, 65% versus 20%. But, who knows where that is. But I think the uncertainty is a big deal. Like, we're not going to get investment spending. You and I have talked about productivity. That's going to suffer. Housing is still going to struggle. Manufacturing is going to struggle because, suddenly you can't get that imported part for the same price you could get it 3 months ago, 4 months ago, right? So what does that do to profit margins? I think my main thing is what happens to profits in 2026? Right now, we haven't seen a big deterioration in profit expectations for 2026. Remember, we talked about future profits, right? When we started the year, 2025 profits were at, earnings per share for the S&P 500. It was about 272, 2025. So that's next 12 months, right? Yep. Now we're down to about 265. Josh, you can put up this chart as well. It's down that's about 2.5% down. But you and I know that game. Companies always the expectations go down as you move forward. But 2026 is interesting. Remember, once you get to June, next 12-month earnings will be half of 2025 and half of 2026, right? Just the way the math works. 2026 EPS at the end of last year was about $309 per share. Right now, it's about 301, also a 2.5% decline. So it's come down the same amount as 2025, which means what? Markets are still expecting the same growth rate of profits in 2026. And I don't know. I mean, right. If maybe, even if you think, okay, companies have pricing power, right? They can pass on the tariffs to consumers. You'd still think sales may go down a bit, right? Now, if they don't think they have pricing power, like, we have to eat this in margins, and margins are fairly elevated, so there is room. But if margins go down, in any case, what are profits? Profits are sales growth times margin growth, margin expansion. If one of those gets hit, you're getting a hit to the profit side. So I think that's what everyone's trying to figure out. What happens there?
Well, there's a lot to unpack there. I just kept thinking of the old a frog in a boiling water, where it starts low, and once it starts to boil, the frog just stays in there. He doesn't jump out. Kind of what you talk about the economy, just kind of slow.
That's my word.
What's the old? I think it was Hemingway. Who said, how do you go bankrupt slow and then very suddenly? Kind of like, how's the economy fall apart? Kind of slowly and then potentially very suddenly. So anyway, we're in the slow part of it. We'll see if we can avoid it. We're going to keep talking about it every single week on the Carson's Facts versus Feelings. A couple of things I wanted to point out, just from a sentiment point of view, that caught my attention the last week or so. Goldman Sachs has a hedge fund position survey that they do. It's the lowest since COVID. So again, hedge funds are kind of the most bearish they've been since COVID. Not too shocking. New York Fed, yes, it's a survey. I like it because it's just a free survey. You can find it online pretty easily. New York Fed. You can break it down by income brackets. The highest income bracket's 100,000 or more. The people that make 100,000 or more, according to the New York Fed survey, are the outlook for stocks is the lowest ever, like a year out. I think stocks are going to do the most bearish they've been a year out ever. Okay, so that's something to think about. The AAII sentiment poll, we have talked a lot about this. It's been a record 9 weeks in a row of 50% bears. Honestly, you can say they've been right, though. I'll tell you, last 9 weeks, you're bearish. Hey, more power to you. At the same time, it's hard to think that eventually, when you look at history, we have these long streaks of above 50% bears. Usually, it's been near some major lows. That's in the back of my head. Then the University of Michigan, we talked about that already, but they look at how many people expect the stock market to be negative the next 12 months. It's one of the questions they ask. It's an all-time record also. So, those are some data pieces that caught my attention. One thing that gets me, though, Sonu, you look at the inflows, there actually have been a decent amount of flows. So retail crowd's actually been, to a degree, buying some of this weakness. Maybe they've been conditioned. This is what you should do. At the same time, kind of worries me a little bit that they were pretty worried, but now they're quickly buying. So I don't know, but I think overall, I'd say sentiment is in a pretty negative spot. At least it was this time a week or two ago, which you tend to see at the major washouts with those things I mentioned earlier. Those are some positives on the breadth thrust points of view. Well, let's see. We've got maybe 5 or so minutes. What else you want to talk about to wrap it up here?
Should we talk about gold?
Yeah.
You had some nice charts about gold yesterday morning. Maybe you should talk about gold.
So I came in.
How are you thinking about gold?
Well, we've talked a lot about gold on this podcast. We've had a small allocation in our tactical models that we run for our Carson partners for 2 years now, right? So we've been in gold for 2 years. Not that we're huge gold bugs. I've been on the record many times saying gold and stocks can go higher together. We thought that was going to happen. Look at the last 2 years. Pretty much has happened.
My name is derived from gold.
Yes, that's true. What does it mean again? What's your name?
It's gold. Sonu. Sona is gold in Hindi. Yes, Sonu is.
You said your parents
precious.
like gold. You weren't kidding when you said that. So you've got gold up almost 30% on the year. It's had a heck of a run. You look at flows. We're seeing huge inflows to gold. Everybody's realizing, wow, gold's actually doing well, and that's kind of how this works. But what got me is I opened up my Barron's over the weekend. There's a big gold bars all over the cover of Barron's. I'll be clear, Barron's I don't look at like a contrarian indicator. They made some really good calls, like The Economist and Newsweek, some of the other places that you can maybe fade some of them. So Barron's has been right, but there's a lot of optimism. I don't know if I said this or not, but gold's 25% above its 200-day moving average. That's kind of about as extended as something can get. Maybe it's due for a well-deserved break, well-deserved consolidation. My take right now with gold is if someone hasn't been in any, maybe you wait for a little bit of a pullback because it'll happen. But structurally, I think that major breakout that we talked about on this very podcast 2 years ago when gold was breaking out, I remember we talked with Monty Carson, about this, and he's like, "What's your target on gold?" I look back on the team's messages. This was years ago.
Okay.
I said, I kind of made up a number. Like, I don't know, Sonu, what should we say? But we said 2,500. That was when it was like a 2,000.
Wow.
Okay, and now we're at 3,300 right now. What I've said before, gold for 11 years from ballpark 99 to about 2010, 2011, gold went up. So approximately 11 years. Then it went sideways for 11 years from 2011 to 2022. And then it started to break out. These cycles last a lot longer than you think. Gold's done amazing. I think 2-3 years from now, we're going to look and gold's going to be a good deal higher, but honestly good. I think the stock market's going to do okay also. So, that's kind of my views on gold. I went all over the place, but we were one of the first people that I knew of that really turned structurally bullish on gold and actually added it to the money that we run for our Carson partners. Not a lot, right? I think we have about 4% gold now. We've tinkered with
in our moderate allocation.
We've sold some, we've added some, but we've had gold exposure. And you remember on this podcast, we talked about after the U.S. election last year, dollar soared, which is crazy because that has not been what the dollar's done lately. Gold was just lit up. I remember talking in team meetings like, listen, gold's in a bull market. I like buying things that are getting crushed short-term in bull markets. We had a little more gold last November, thank goodness, because then you look, gold's up well over 30% on the year, at least it was. That's helped our our models do pretty well. Because, we're overweight equities. This has not been a good year to be overweight equities. There's different areas we've talked about this. We've got a lot of international exposure, probably more than most other advisors and RIAs do, which has really helped. We've had some low volatility in there as well, which is done. Low volatility is up like 3 or 4% on the year, right?
Low vol stocks,
10%, low vol stocks. So, still, if you're in equities overweight, it hasn't been a fun year, but we've had some treasuries, we've had some gold, which has really, really helped the models that we run for our Carson partners. What's your take? Given your name, it's all about gold. You should know this.
I feel like, me talking about gold is very biased, but no, I'm not a gold bug by any stretch. Look, I don't know.
Are you even allowed to say that?
I know. It's like I lose my card or something.
Yeah, you're not going to go back to. Don't tell your sister she's in town. Don't tell her she won't like hearing this. Yeah.
I know exactly, but no. Look, I don't know what gold is going to do short term in terms of charts, but I think longer term, right? You think about the real damage that I think what's happened right now over the last several weeks is we saw, despite markets rallying, and bond yields also went down, right? Yep. We've reversed some of that, the scary stuff that happened a couple of weeks ago. But the dollar is still not rallied. That is interesting. That everything else is reversed. And not quite all the way, but close to reversing everything we saw from Liberation Day, except the dollar, right? And if you think about if America's goal is to reduce trade deficits, what does that mean? That means the rest of the world is getting less dollars. They're getting fewer dollars, right? And maybe they trade more with each other. Look, all the stuff that's not coming to, for example, if you think about it, all the stuff that is not coming to the U.S. from China right now, right? All your bed sheets, linens, toys, whatever. It's still there in China. They have to sell it to somebody, right? And the Chinese are not going to buy all of that. I mean, so they have to sell it to the rest of the world. Let's say they sell it to Brazilians and Indians and Vietnamese and all of that, right? Some of those goods will find their way back to the U.S. through Vietnam, which is why freight rates from Vietnam to the U.S. is going up a lot. But freight rates from China to the U.S. is going down, right? So we know what's happening. But still, they're going to sell it to the rest of the world, which means what? They're going to get Indian rupees, they're going to get Brazilian reals, Turkish lira, whatever, right? And these are not very convertible, deep, liquid markets or currencies. So they're like, we don't want to hold this stuff. What do they hold in return? Gold. I think that is the long-term demand, I think, for gold, especially if U.S. trade deficits start to go down and the rest of the world still continues to trade. I think that's why I think you get longer-term, really, let's say over the next 5, 7, 10 years, right? I'm not saying this is the end of the dollar as a reserve currency. I don't buy into that stuff. Right. I think the network effects are just too large. And the U.S. economy is $29 trillion. So come on, people are still going to trade with us. They will get dollars and they will invoice in dollars and all of that. But still, on net, if the rest of the world gets fewer dollars, if they start trading more with each other, I'm happy holding dollars, but I don't want Indian rupees. Right? Because who knows what can happen with the Indian rupee, right? You know what? I'll buy some gold instead. I'll keep that as my reserve. So I think there is that structural demand going forward probably for gold. And we've used gold as a hedge because, yes, we do like bonds, but not to the extent we probably would have liked bonds over the last decade.
Right.
Because going forward, if you think, okay, there are these various inflationary episodes, right? 2022, we saw that. And then inflation's going down. But even in our strategic long-term models, you're like, you know what? We could still see inflation volatility. And now we got this tariff thing. And that inflation volatility could come sooner rather than later. But that's why we don't want to bet all our diversifiers on bonds. We want some gold. We want some managed futures and stuff like that. So I think that's how we're thinking about the long term. And from that perspective, I think, gold's got a little place in the portfolio.
Yeah, no, well said there.
I'm smiling while I say that.
If you want to hear the latest from us, don't forget to subscribe to our podcast. You can leave a review. We love your feedback. It really helps with the algorithms. Also, we have an email, facts versus feelings versus vs@carsongroup.com. Please let us know what you think. And Ed Yardini, big fan of Ed. He talked about back in 2022 when the terrible war started in Ukraine. We started to see central banks buying gold. Yes, China, but a lot of them. And you've all seen these charts before. But that's when something changed. I don't know. But then gold broke out later in 2023 when I turned a little more structurally bullish on it. We turned a little more structurally bullish. And here we are 2 years later, and it's been about the strongest performing asset out there, period. So let's see. I guess we're about the end. So any final words of wisdom? We'll talk more about the Fed next week. I mean, we'll dive into that. Any final words of wisdom as we wrap up episode 133?
I'm almost convinced to head over to Costco and still see if they have gold bars or something. You know, a decade. Here's my gold story. Sorry, not to go off complete tangent. About 15 years ago, I think it was 2007 or something like that. 2006. I told my dad, like, Dad, buy some gold coins. Like, I don't think anyone starting their careers off would have been like, I'm going to spend my money buying gold coins. I ended up selling it in 2012 or some 2011. 2012.
Peak.
Yeah. So not that I was trying to time it, but it was I needed the money for something else.
Okay.
Right. But now in hindsight, I'm like, maybe I should have kept it. It's like, if you go back and look at gold from, I don't know, 2006 to now, it's probably beaten the S&P 500, right? So
I think if you start in 2000, gold's beat. Now we're playing with numbers or playing with starting.
Right.
You start in 2000, a major peak in the stock market. I mean,
there you go.
Gold obviously gold did well. But anyway,
that's why. Final thoughts. I mean, I'll just say, look, this is why you want diversified portfolios because uncertainty is really high right now. When you have a lot of uncertainty, our friend, our colleague, Grant Engelbart wrote a nice piece about this. We'll maybe link it in the show notes or something. When in doubt, and there's a lot of doubt now, diversified out.
Yeah. No, when in doubt, diversified out. I like that. That was really a good one by Grant. So I'm going to ask you a very difficult question. So in episode 133, what was the title again? I don't remember.
Oh my God. Did the stock market win the tariff throwdown?
There it is.
Try saying that 10 times.
There you go. Did the stock market win the tariff throwdown? Normally I write this stuff down, but here's another thing. So I get these booklets, right? These are nice little booklets. You know, it says Carson on.
Oh, is that from Carson? Oh, yeah. Those are really good.
On the last page. I am on the absolute last page, so I couldn't write down what episode we're on. And
I've got 3 of them.
Now,
just to make you jealous.
Now I had a bunch. I asked home office. They sent me some of these old ones. Those are good. Old Excel stuff. So they sent me like 3 or 4 of them. So I get to start a new Carson booklet with all the cool stuff that we work on, and I just love to call it old fashioned. Put it down by hand.
Hint. If somebody at Carson, hopefully a lot of people at Carson are listening to this, maybe they can pull a couple of books.
Well, I'm set. I mean, Maria hooked me up. I got 3 or 4 of them over there, so I'm set. Probably honestly for the year. I think. I mean, usually it takes about 3 months or so. I fill one up. But anyway, with all of that, everybody, thank you for listening. We really appreciate it. We've hit some really big numbers the last several months. Obviously, market volatility is a big reason for that. The YouTube channel has been doing really, really well. It's one of our big goals this year was to get more views and downloads, and thumbs up, and all that stuff on the YouTube channel. And we've been doing that, and we couldn't do that without all the consistent listeners. And we put a lot of time, a lot of effort into this. We like to have fun. Always learn something. I don't know what Sonu's going to say. You don't know what I'm going to say. I'm honest to God. If you can't tell, this isn't a scripted podcast. If you can't tell, I don't even know what the title of the thing was. We've been talking for 50 minutes. Anyway, but it was a lot of fun. We got some green, some better times out there. We'll be back next week to talk about all of it again in episode 134 next week. But with that, everybody enjoy. And May is here. Probably talk about Sell May go away next week as well. Don't go away. There's a quick summary. Don't go away. Don't go away. We'll
stay with us.
That's true. See everybody later. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.